Well, I'm Tom Mustin with Stansberry Research. Glad you're with us today. We are here talking to Stansberry editor extraordinaire, Dan Ferris. He's the editor, of course, of the monthly newsletter, Extreme Value. Dan, thanks for joining us. Really appreciate it.
You bet, Tom. My pleasure. Good to be here.
Let's talk art to start off with here. We thought the art world had seen it all when a banana duct taped to a wall sold for 150 grand. And now we just learned the world's first invisible sculpture is sold for more than $18,000. Okay, these obviously are outliers, though, because it sounds like sales of these so-called digital collectibles have really fallen dramatically. And given the volatility of cryptocurrency, I'm going to ask you, has the digital asset bubble finally burst here?
With NFTs in particular, it's too early to know how this will all play out. As a mania, certainly the froth is coming off of crypto and by association NFTs as well. But in crypto particularly, if you just even watch the very top assets, Bitcoin, Ethereum, they came way off. They're 50% of their highs, and having trouble getting much back up past that. So, yeah, I think the froth has largely come off of crypto, and some of the other assets are down much more. 70, 80, 90%. So, yeah.
So let's switch gears a bit here. So in your newsletter, you talk about these so-called zombie companies, the companies that are so far in debt they'll never get out of it. Right now, I'm looking at the Russell 3000 index, and about a quarter of the companies can't pay off their debt. So why does it matter in the broader market here if zombie companies, and as you put it, these garbage stocks start to sell off? Why is that a problem?
So it may not be a problem. If all that sells off, maybe we just get that. Maybe we just get a return to some kind of normalcy. I think the odds are good that sell-off infects the broader market, because the broader market has never been this expensive before. It's the U.S. stocks are 2 times GDP. 2 times GDP has never been that high before. Nothing like it. And the S&P 500 is 3 times sales. It had never been higher than about 2.3, until maybe earlier this year or early last year, actually. So we're in uncharted territory as far as valuations go, and logic would suggest that when you pay the most you've ever paid for an asset, you're going to get the worst return you've ever gotten over some period of time, maybe 3 years, 5 years, 10 years, we don't know. Certainly all the measures that have correlated most negatively with the S&P 500 in the past are elevated to their all-time highs, suggesting that we're going to get the worst returns we've ever gotten over the next maybe 10, 12 years on average than we've ever seen. That's what history suggests to us. So I think it's reasonable to suggest that, hey, maybe this is like .com 2.0. All the .com garbage sells off, and the S&P 500 in June 2000 was down maybe 4% from the March high, and all the garbage had started to sell off big, and people were saying the same thing. Oh, maybe that's it. Maybe it doesn't affect the broader market. And then 2 years later, we're down 50% on the S&P 500. So I think we're ripe for that kind of thing to play out here.
And of course, the X factors, we're coming out of this worldwide pandemic. So, the future is very much a question mark. But I was listening to your podcast, and you said that you're almost 100% bearish. Okay.
Right.
So, well, I'm going to ask you, so say you're a news anchor in Denver, Colorado, and you're looking to invest. What words of advice can you give to this budding investor now, given the market circumstances right now?
Well, the number one thing is have a long-term perspective and be truly diversified. And for me, truly diversified means you have some assets in the financial realm, in the currency regime. You hold plenty of cash, hold your stocks and bonds, that's in the currency regime, and then go outside of it with some silver, some gold, maybe a little bit of Bitcoin, which I think has excellent potential to be a huge multi-bagger over the longer term, 5, 10, 20 years. And that, to me, is a good basic truly diversified portfolio inside and outside the currency regime. You can also buy to preserve value long-term things like real estate, or, if you are a car buff, maybe you're going to collect Ferraris, or if you're a guitar buff, maybe you could collect vintage guitars, have a small percentage of a portfolio in that. But that depends on your personal knowledge and personal preferences.
Well, great information as always, Dan. Thank you so much. Dan Ferris is with us. I'm Tom Mustin with Stansberry Research. We look forward to seeing you all again very soon.